special purpose frameworks. So what is special purpose framework? So like frameworks means how do you present your financials, right? So special purpose frameworks can be on the cash basis, or maybe on the tax basis, or there are some other basis of accounting as well, which we'll discuss. So basically special purpose framework are also called other comprehensive basis of accounting, OCBOA, right? Let's start. First, also known as other comprehensive basis of accounting, are non-GAAP presentations that are widely used. So this is non-GAAP presentations, right? Examples: cash basis, modified cash basis accounting, and tax basis accounting. Other important points: financial statement titles should be different from basic financial statements, right? This should be C, sorry. So like in case of basic financial statements, so here we do not use terms like income statement or balance sheet. You have to give some different name, like say statement of assets and liabilities, statements of revenues and expenses, right? So you cannot use the terms which we use for basic financial statements. Next is, a statement of cash flow is not required. So when you are preparing on other comprehensive basis, cash flows is not required. Next is cash basis financial statements. So in cash basis financial statements, revenues are recognized when cash is received and expenses are recognized when cash is paid. Financial statements include a statement of cash and equity and a statement of cash receipts and disbursements. Then modified cash basis. So modified cash basis can be used, means that you will prepare everything on the cash basis, but there can be a modification, like for example accrual of income tax, just to show that income tax, and then maybe capitalizing fixed assets and depreciating. This should be done along with the cash basis accounting, or maybe valuation of inventory can also be done. So there are multiple types of modifications which are used. Hybrid method that includes elements of both cash basis and accrual basis. Common modifications include capitalizing and depreciating fixed assets, accrual of income taxes, capitalizing inventory, reporting investments at fair value, and recognizing unrealized gains or losses. So one point to note here is that modification cannot be for accruing income or expense, right? So if we do the modification of accruing income and expense, then this becomes the accrual basis of accounting and not the cash basis of accounting, right? Next point is, financial statements include a statement of assets and liabilities and statement of revenue collected and expenses. Then next is income tax basis financial statements. Here prepared, like financial statements are prepared based on methods and principles used to prepare the entity's tax return. Then non-taxable revenues or expenses. So there are three methods how you can show the non-taxable revenues, right? There can be a separate line item in the revenues and expense section, or the addition or deduction to net income, like first you calculate net income, then after add non-taxable revenue and deduct non-taxable expense, or maybe you can just calculate net income on the basis of income tax and then disclose in the notes to accounts that these are non-taxable revenues or expenses. Financial statements include statements of assets and liabilities and equity, and statement of revenue and expenses and retained earnings. So these are just the difference of names. Next, converting cash basis financial statements to accrual basis of financial statement. This is important. So the process of converting is the opposite of the process used to prepare the statement of cash flows from the accrual basis of accounting. So we know that when we prepare cash flows in accrual basis of accounting, what we do, uh, we take income and expense, we add unearned or prepaid to it. So that means that income on accrual basis plus what we have received, which is either not earned which is not earned, and then less paid, yeah, earned, yeah, earned but not received, right? So by this method, like and deduct year-end accruals to get cash basis of accounting. This is how we used to calculate for our statement of cash flows, right? So now we have to convert this which was calculated back into accrual basis, right? Let's see how we do this. First is converting cash basis revenue to accrual basis revenue. So accrual basis revenue would be equal to cash basis revenue. So revenue on the basis of cash, like whatever cash you have received, then adding the ending accounts receivable and deducting beginning accounts receivable, because like you have to accrue, right? So ending accounts receivable is also your income, but the beginning accounts receivable which you would have received and included in this should be deducted because this is not for current year, right? Then beginning unearned revenue. So beginning unearned revenue is added because there was some revenue which was received in previous year but was earned in this year, so we will have to add this. And ending unearned revenue means something you received in this year but it is not earned yet, so you will deduct it from cash basis to bring it down to accrual basis of revenue, right? We'll do a question on this. Next is converting cash basis for of purchases to cost of goods sold. So cost of goods sold would be cash paid to purchasers plus ending accounts payable, which is still to be paid, but it is purchased this year, so this is current year's cost. Then beginning less beginning accounts payable, so which was purchased in previous year but would be included in this, so we'll have to deduct those. Then beginning inventory you have to add back because we consider the beginning inventory is sold during the year, so we'll add it to cost of goods sold. And then ending inventory is deducted because it is included in purchased but it is not used in this year. It will be used, it will be included in the COGS of next year, so it will be deducted. Now for operating expense to convert operating expenses into accrual basis, cash paid for operating expense plus ending accrual liabilities minus beginning accrued liabilities. This is accrued, so this will be added back to this. Beginning accrued means this was for previous year but not received, so it would be included in this, we will deduct this. Then beginning prepaid expenses means which were paid in previous year, it is not included in this, so we will be adding it back. And then ending prepaid, we have paid in current year but this does not relate to current year, this is for future periods, so we'll deduct this, right? Let's see a question on this. Oh, sorry, one more point. Above adjustments and calculations can be combined to calculate the accrual basis net income. So basically, we calculated revenue, we calculated COGS, we calculated operating expense. So to arrive at net income, we'll just deduct these two from revenue to arrive at net income, right? This is accrual basis net income. Okay, so let's see one question on this, right? Brack, an accountant, keeps his accounting records on cash basis. During year 2, he collected 100,000 in fees. Collections है. This is collections. 100,000. Then and at December 31st, year 1, Brack had accounts receivable of 50,000. This is opening year. Let's write down everything and then we'll see what we will add and what we'll deduct, right? At December 31st, year 2, Ward has accounts receivable of 70,000. Closing AR of 70,000. Then an unearned fees of 5,000. Unearned fees of 5,000. Now you have to calculate on an accrual basis what Brack's service revenue for year 2, right? Revenue for year 2 you have to calculate. So opening AR would mean that this was receivable in previous year but was not received. That means this was earned in previous year but was not received, right? So this is not the earning of current year, we'll deduct this. Then closing AR means This is an earning of current year, but you have not received it. You might receive it in future period, but on accrual basis, they should be considered current year's income. So we will add it. Then last is unearned fees. So fees which you have received but not earned. So maybe you will earn it in the future period, but for this year you will have to deduct it. So what is the net value? Okay, 50, then 120, 115. 115K is the answer for this question. Okay, that's it guys. Thank you so much. Please like, share and subscribe and ask your questions on the comment section. Thank you so much.